Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings Monthly Conference Call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press star 0. I would now like to turn the meeting over to Sarah Potofsky. Please go ahead, Ms. Potofsky.
Good afternoon, and thank you for taking the time to join us on the Barometer Readings monthly conference call. Since our last call, the market has recovered from the recent consolidation, and our indicators are broadly positive. Joining us on the call today is David Burrows, President and Chief Investment Strategist, along with Sal Malik, Portfolio Manager. Dave is going to elaborate on what we are seeing in our models, and Sal will highlight recent changes in the portfolio, in particular our increased energy exposure as of late. With that, I will pass it over to Dave.
Hey, folks. Thanks for taking the time today. So since the last time we spoke, I guess in the last conference call, we talked about the fact that we do believe we have moved into a more sustainable secular bull market for equities. We talked about the fact that we did expect to see short-term corrections and pullbacks, but they would tend to be more shallow by nature, that you would see pullbacks and profit-taking in leading names and sectors, which is quite different than what you see in a more significant correction, but that they would see buyers come in relatively quickly, and the pullbacks would likely be less than what people are hoping for. And we continue to see that as being the case going forward. Some of the short-term indicators that we look at, which include percent of stocks above the 50-day moving average, percent of stocks above the 200-day moving average, percent of stocks with positive price momentum, and the percent of stocks hitting new highs versus new lows, all consolidated over the last 6 weeks, but in the last few days have turned higher again. World bullish percent is sitting at about 54%. That has been at that level now for about 2 months. In other words, the pullbacks that we saw in some of the leading stocks did very little to create any damage in the overall indicators. We had some sectors that had been leading sectors pull back from a breadth perspective, like biotech and technology, internet, and internet retail. Each of those sectors went sort of coast to coast, pulled back to quite narrow breadth, and have turned back higher again. Signaling money is starting to move back into those groups. And overall, we are seeing the themes that led the market last year continue to move forward. So from a breadth perspective, market's behaving in a healthy manner. When we look at valuation, certainly where 10-year yields are down here at 273, make stocks very attractive, where the S&P has an earnings yield of just less than 7%. So you're getting paid a very healthy risk premium to buy equities. And in a world where excess return has been squeezed out by dollars looking for a return above a risk-free rate, certainly equities continue to be a very compelling case. Breadth is good, valuation very reasonable. You know, ultimately, you can't forget that a 10-year bond is trading at an equivalent PE of about 37 times earnings, and the S&P is about 17 times earnings, certainly the values in stocks. The potential fly in the ointment, of course, would be if we thought long-term interest rates were about to move a lot higher. I think if when we were talking last September, if we had said that the Fed would be very active in its tapering and yields would still be down in the 270s, you would have been surprised. So a lot of the folks, I think, that thought there would be a lot of damage to the Treasury market when the Fed eventually made its exit are surprised. Yields have been working their way sideways. It's been our view for some time that the 10-year would likely trade in a range of 275 to 3.25 after making its initial move up from 1.5% 18 months ago, and that continues to look likely. When we look at other measures of market perception of risk, we can see that, first of all, the weaker countries, the peripheral countries' yield spreads have continued to narrow. You know, Spanish debt trading roughly in line with U.S. Treasury bonds from a yield standpoint. Italian and Portuguese yields hitting multi-year lows relative to Treasury bonds, so no sign of credit risk showing up. When we look at high yield and investment grade spreads globally, they've been narrowing very steadily and are basically at multi-year lows. So both breadth and valuation are positive. When we look at measures of risk in the market, we don't see any expansion in the credit spreads. So ultimately, we have a credit market that's behaving well, we have an equity market that's behaving well, and all the while correlations, continue to fall. Now, from an economic standpoint, we know that from the beginning of January through the beginning of March, the Citigroup Index of Economic Surprise pulled back fairly steadily as some of the economic data came in weaker than expected. I think a lot of it due to weather. That started recently to hook higher. The fact that the market sucked up bad news effectively without giving up much ground, again, tells you that there is a lot of strength underlying. And relevant to our income strategy, dividend payout ratio in the S&P continues to be below 35%, well below the long-term average of 50%. So there hasn't been a lot of change in the underlying portfolios. High income strategy has had a strong exposure for some time now to financials, to healthcare, to industrials, to consumer discretionary, more economically sensitive groups. However, we have been steadily increasing our weight in energy, and I'm going to get Sal to talk about that in a few moments. But really, from a sector perspective, the biggest changes we've been seeing is in the energy space. Geographically, developed markets continue to look far more attractive than developing markets. Developed markets, another way of saying consumer-led economies. Consumer-led economies, we certainly see are leading from a breadth perspective. And when you look at what's happening underneath the surface, earnings in the developed markets are growing very nicely, where earnings growth in the emerging markets actually has been falling away now for 18 months. So a very clear divergence in earnings growth and price performance. Low inflation, great for consumer-led economies. So we're seeing falling correlations and rising PEs in the consumer-led economies, the developed markets. So specifically, we've been focused in North America with some small focus in Europe. And as we see a continued slowdown in Asia, that should perpetuate low inflation and should perpetuate the leadership in developed markets. So from a sector standpoint, over the last 6 or 8 weeks, the most significant improvement has been in the energy producers and the oil and gas service companies. And you've seen that there's been fairly steady expansion in our ownership in the portfolios. Production in the U.S. continues to grow rapidly, but more importantly, costs of drilling and bringing on reserves and production continues to fall in the U.S. Beyond energy, financials, technology, industrials, and healthcare are our core focuses. The equity portfolio also has seen the same move, a very substantial increase in our energy exposure, followed closely by industrials at 25% of the portfolio, technology at 14% of the portfolio, consumer discretionary at 13%, and financials at around 10%. So what I'd like to do is I think that we've spent a lot of time over the last 3 years talking about energy infrastructure, and energy infrastructure continues to be a significant focus for us. We also have spent time talking about the more growth-oriented producers who are using technology to their advantage to grow production and reserves. But there's probably really 5 neighborhoods we're focused in energy, and I've asked Sal to spend a little bit of time today talking about each of those because it is an important theme for us, and then just highlight a couple of the names in each of the groups. So I'm going to pass it over to Sal for a moment.
Hey, thanks, Dave. So when we look at our energy exposure, when we're looking for growth, our focus is mostly in the U.S. market. The 3 basins there, the Permian Basin, the Eagle Ford Basin, and the Bakken play. So within the Bakken play, we believe Whiting Petroleum is one of the best companies. It's a mid-cap company and we expect a production growth of around 25 to 30% for the next 5 years. And they actually have been able to bring their costs down at a CAGR of around 8% over the last 5 years. So we think as long as oil price is stable, they stand to do quite well, and they will keep going through multiple expansion. Within the Permian Basin, it's the newest one in terms of horizontal drilling, and our exposure in Concho, Diamondback, and Matador have done quite well. Again, these companies are growing production by 25 to 30%. Costs are coming down. For Matador, they actually have been able to bring their cycle time down from almost 25 days to 15 days, and everyone in U.S. is doing pad drilling. That is resulting in lower costs, meaning higher netbacks and better profitability. Within the Eagle Ford play, we love EOG. EOG has one of the strongest management teams. They have the best acreage in the play, and we think that they can do a 20% production growth for the next 3 to 5 years. So when we look at oil and growth, our focus is in the U.S. market because they're closer to Gulf of Mexico, they're closer to refineries, and they're getting better pricing. Now, the second theme within the energy space that we are focused on is the energy income play. You know, as Dave has mentioned, how the U.S. 10-year has stabilized around 2.7% running yield. So companies like Crescent Point, Whitecap, Baytex, and ARC that have a 4 to 5% dividend yield and are in position to grow production by 5 to 10% on an annualized basis, and that sustainable business model are seeing their multiple expand because they have yield and pricing is quite stable. So within our income strategy, these are the core names that are generating sustainable, stable income for us. When we look at, so currently right now, the third theme is the heavy oil. So currently right now in Canada, when we take all the oil production and NGL production, Canada is producing around 4 million BOEs per day. Out of that 4 million, by the end of this year, 700,000 BOEs will be getting moved on rail. We have Flanagan Pipeline coming online second half of this year. That's the Enbridge pipeline. That's going to move heavy oil towards Gulf of Mexico. So we are quite constructive, and we have been quite constructive over the past 3 months on heavy oil differentials. So not only you should be looking at the heavy oil differential between Western Canadian Select and WTI, but also between Western Canadian Select and Maya. That's the heavy oil price that you're getting at near Gulf of Mexico. And these spreads have been coming in because there's more rail capacity coming online, more pipeline capacity, and our positions in MEG, CNQ, and Baytex, all three are benefiting from this theme. We think the analysts are behind the curve, and the estimates for all these three companies will keep going up, and heavy oil differentials are going to be quite tight, and this could be the new norm because of the excess capacity that's coming online, so they will get higher pricing. The big game changer so far this year has been the natural gas. If you look at storage right now, we're sitting with 826 BCF or 0.82 TCF of gas in storage right now. Last year at this level we were at 1.7 TCF. A 5-year average is 1.8 TCF. So there is a lot of gas that needs to go into storage. Utilities are short gas, and we think that this could set up a good price environment for natural gas producers for the next 2 to 3 years. So when we look at Canada, our focus on the natural gas side is on top quality companies like ARC, Paramount, and we all on the small to mid cap side we like True Energy because they have a massive position in Montney and the resource is huge. So those are the 4 different themes that we are playing within the energy sector, followed by the 5th one, that's the energy service. In U.S., Core Labs. So Core Labs is a monopoly in terms of doing seismic, core sampling, and they don't actually have any competition. And the stock has had an amazing move over the past 2 years and keeps going through multiple expansion. Last week we got a 24% dividend increase from Core Labs. We think the stock has a lot more legs. Another name we own is Halliburton. They reported results last week. Results were good. Their business is doing well in Asia and the Middle East. Margins in South America were quite good, and North America is getting better. So we expect after the breakup season, a lot of E&P companies are going to increase their CapExes, and that should result in higher utilization rate for the drillers and the fracking companies. So there's a good probability that they also go through multiple expansion. So the energy services companies like Secure Energy is another name we own. We have a small position in Trinidad, so that's the way we're playing this theme. From all our work, we think that there's a good opportunity for all the companies within the 5 themes that I've mentioned, mainly oil growth in U.S., income oil names in Canada, heavy oil names in Canada, and natural gas names in Canada, and the energy service names. They all can go through multiple expansion. And we expect revisions in terms of earnings, EBITDA, and margin to the upside. So we're quite constructive, and I'll pass it back to Dave.
Great. Thanks, Sal. So, I thought maybe it would make sense as we go along here to spotlight 1 or 2 of the core themes in the portfolios on each of the calls. What I find compelling is when we look at these growth-oriented producers in the U.S., if you think about it over time, drilling holes was a risky bet, and you might have a 60 or 65% success rate, so you only put a low multiple on companies like that. If they're highly dependent on the price of oil, and the price of oil is volatile, you put a low multiple on that. As we go along, what's happening is you're having technology be used to create a mass manufacturing opportunity where hit rates today are close to 100%. The cost of drilling is going down, and we are not investing in companies expecting high commodity prices. We're just buying manufacturing businesses that are able to grow their production. When things become more predictable, they trade at higher multiples. And the multiple for the oil and gas producers is just in the process now of breaking out of a range that it's been in for the last 5 years. So we think that there are legs in this theme, and so we've made a pretty significant commitment. We recognize that from a time of the year standpoint, we're coming up to the end of April. We know there's a lot of people who do believe in the sell in May, go away theory. We think it's possible it doesn't play out that way this year, and so we've got a pretty good size commitment. Having said that, we're never married to anything, and if things start to change, if these things start to fail, then we would start to move away. We just don't see any sign of that at this point. We have pretty strong conviction. So overall, the theme continues to be equities is the asset class we want to focus on. We think that a targeted strategy is the right strategy, especially in a world where correlations are falling, stock to stock, sector to sector, and market to market. We think that with falling inflation, consumer-led economies will continue to lead. We think we have a stable interest rate backdrop. And the last piece is we continue to believe that both private investors and pension fund investors under-own equities as a percent of their total investment portfolio. The flows into equity funds really only started a few months ago, and we think that we probably have years in front of us where we see money move from fixed income to the equity asset class for compelling risk premium. So as we head into May, our work is sort of pointing to green lights. I'm sure that there are going to be bumps along the way, but we think that we continue to see each of these pullbacks as being met with pretty significant buying. So in the absence of anything changing, we'll look forward to the next conference call, but we're certainly happy to take any questions that people may have.
So before we take any questions, I'd just like to thank you again for joining us.